Vice President, Capital Markets at Amvest Capital in New York. Welcome to the Amvest Capital Inc. live webinar with Westvault Mining. Westvault trades on the TSX Venture as WVM and on the OTCQB as WVMDF. Hope you'll enjoy today's program. Will also be available in replay mode. Feel free to chat in your questions in the question pane of the GoToWebinar control panel, or simply email them in. We'll try and ask the questions in real time or after the webinar. Amvest is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. Please note this call is for informational purposes only. We're very pleased to have with us today Mike Jones. Mike, making you presenter. An engineer by background, Mike brings over 30 years of experience as a professional geological engineer and has been instrumental in raising over $1 billion for exploration, mining development, and production. He's also the president, CEO, and director of Platinum Group Metals, and co-founder and former director of MAG Silver, and co-founder and former director of West Timmins Mining, which was purchased in 2009 by Lakeshore Gold. Following the formal presentations, members of Amvest Capital will ask questions of management. We'll also look forward to any attendee questions that you would have sent in. So thank you and welcome, Mike.
Thanks very much, Campbell. Thanks for the introduction. Normally we have a webcam review, but we got a little technical glitch in the system, so assume everybody can see the slides. And
all good.
Thanks for joining us.
Put it in full screen mode there.
Sure. So the first picture actually is really indicative of the project. We're looking at the Hasbrouck Hill, where the gold reserves literally stick out of the ground, and that line, Nevada Gold Reserves. That actually is about where the pit rim will sit at Hasbrouck. So from a mining perspective, this is about as simple as you can get. And you can really look at this company as a way to get out $1 billion of gold with a $100 million market cap. So we believe the company is significantly mispriced, given the peers in the space trade at about 0.7 or 0.6 times NAV. And I'll show you those numbers in a second. But this is a conservative, solid way to get out a large amount of gold secure in Nevada. Standard disclosure language. The information today will be from a technical study and independent engineer work, and a cautionary note to U.S. investors that we will be using the Canadian national standards. This is really where the rubber hits the road, is in the summary of value. So the net present value on a discounted cash basis at $1,800 gold from our independent engineers is $5 US a share. We're trading at 1, so significantly mispriced against our real asset value. It's a very simple project. It's all oxide at surface, ready to be heap leached with a low strip ratio. And the net present value of the asset, which we just recently consolidated, is $295 million US at $1,800 gold. The project internal rate of return is 92%, and at current gold prices, it's actually over 100%. It's a very well-known asset in that it's been drilled with 600 holes, and it's a high margin reserve with an all-in sustaining cost that many gold investors are familiar with at $709. The initial capex is quite low at $47 million, and this reflects the first pit, which is run of mine straight to the heap leach pads. And we now have the first pit permitted, and interestingly, the presentation needs to be updated. It says the second pit nearly permitted. In the last few days, we actually have achieved that permit. It's 71,000 ounces of gold for about 8 years. In a recent transaction, we consolidated 100% of the project, and this obviously makes it easier to finance, it makes it easier to build, and it makes it more interesting from an M&A perspective. We bought the interest from Waterton, a 25% interest, and we paid both in cash and shares, and that was the use of proceeds of our last financing. This is an area I know very well. Used to run the Sterling Gold Mine in Nevada, another heap leach operation just down the highway, ran that for 6 years, bought out the private partner, did make earnings per share, and so this is really like going home for me. It's a very prolific gold trend. There is other exploration going on around us, and it's right next to the town of Tonopah, which is a mining town for the last 100 years. So there's a very mining-friendly jurisdiction, best in the world, really. It's a very large land position, as shown here. There are 3 parts to the property. The Three Hills pit is first in the north, and then we move on to the Hasbrouck deposit where the bulk of the reserves are. The Hill of Gold is a non-compliant historic resource. It's about 30,000 ounces, and we're currently doing the permitting work to just add this material onto the Three Hills permitted heap leach pad. This adds significant value actually because it's exposed right at surface and it's kind of ounces in our back pocket. The deposit itself is just under 1 million ounces, so it's sizable. The resource to reserve conversion was done back at $1,250 gold, so there is some upside there in terms of reserve conversion, but officially signed off by our independent qualified persons are 762,000 ounces of gold in the 2 pits as shown here. And with metallurgical recovery on a heap leach basis, that puts 577,000 ounces in your pocket. There is some excellent exploration potential here right in the root of the Hasbrouck pit. So this is a plan view and then some cross sections on the eastern end of the pit. And you can see some quite high grade intercepts, including 48 feet of 0.22. And the pit angle is shown here at about 45 degrees. So simply steepening that pit angle or slotting that at the bottom will add some potential. And it's quite awkward to drill it because of the shape of the hill. So this is something that will be developed over time. It gives good potential to extend the mine life with quite a high grade. This is the production profile over time. So the first 2 years in the blue bars, starting out with 54,000 ounces in the first year, going up to 83,000 ounces. And you can see in year 3 that adding the Hill of Gold deposit for 30,000 ounces would really fill in that transition point when we move over to the larger Hasbrouck pit. Hasbrouck is the gold bars. It peaks at about 98,000 ounces in year 5. And as I mentioned, years 9 and 10 have good potential from deepening the Hasbrouck pit. These are the basic stats technically from the pre-feasibility work. We do plan to look at putting this property into production on the pre-feasibility study. Really the only thing that's left to do for a full bankable feasibility study or definitive feasibility study is the pit angle at Hasbrouck, and we've actually set that at 45 degrees in any event. And the drawings that we have are sufficient for construction. So there's no reason really to do more engineering work. We're ready to put this into production now. And certainly with the permits, we're in great position to do that whenever the shareholders want. What makes this project work is that it's a sizable tonnage rate, 15,000 to 17,500 tons per day. And we get 81.5% metallurgical recovery from the first pit, and then slightly lower on the Hasbrouck pit, which is larger. But the low strip ratio at 1.1 to 1 means you're just moving very little waste with every ton of ore straight to the heap leach pad. And again, in terms of value here, and these are the independent engineers' numbers, at $2,000 gold, you're looking at a net present value, 5% discount rate after tax of $356 million. And an IRR of 109%. These values include a 1.1% royalty that we actually bought back from Newmont. Newmont coveted some exploration ground that we had, and so we sold that exploration ground in exchange for the royalty over our own ground. When we completed that transaction, we announced it. We got a lot of interest from royalty companies. We could have just canceled the royalty because it's over our own ground, but with that high level of interest, we decided to crystallize the value of that royalty. And currently at net present values at between $8 and $9 million US. So that's something that's in our near-term milestones. So permitting outlook, again, this slide is a little bit out of date. We actually achieved this permit just a few days ago. So we have the first pit fully permitted, and the second pit now has its federal permit for construction and operation as well. We've talked about this NSR and what it's valued at. Again, it's quite an interesting strategy for the company because we currently have about $2 million US in cash and no debt. And this would add something like $8 million, $7 million worth of cash to the till if we were able to crystallize that value. Our share capital structure is quite interesting. So we have 57.9 million shares issued and outstanding, and fully diluted 61.198 million shares. Our market capitalization is a derisory $100 million Canadian. So as you can see, we're just not reflecting the net present value. The structure of the ownership is that Sun Valley Gold owns 46% of our stock. Ruffer and Eric Sprott and Gold 2000, also major institutional shareholders, and 72% of our shares are actually held in our top 4 shareholders. So it's both an advantage and a challenge. Liquidity is definitely an issue that we need to work on, and continually do conferences like this, sessions like this, to improve the liquidity. But the flip side is it shouldn't take a lot of work to get the stock to more reflect value. The board is quite strong. We have Peter Palmetto, who's our largest shareholder, is on the board. He's the portfolio manager of the Sun Valley Gold Fund in the US. Pierre LaBelle is a director. He's the chairman of Imperial Metals, which is a long-standing producing gold and copper gold company. And Kevin Falcon is the executive at Anthem Properties, a real estate firm. He's the former Minister of Finance and also the Deputy Premier of British Columbia. He's the chairman of our audit committee, so you couldn't have a stronger person in that position. Frank Hallam is the chief financial officer of the company. He, as mentioned earlier, co-founded West Vault Mining with me, Platinum Group Metals, which we also run, Mag Silver, and West Timmins Mining. So in terms of both operations, development into construction, and M&A, we have a very, very experienced team. Our near-term goals, we can tick the box of the first one. We did obtain the first federal permit on Three Hills, and we now have the second one, which we're very pleased to announce. It took about 3 years. And our near-term goal right in front of us is to crystallize the value of the royalty. We also, obviously my dog is also interested in the royalty. So the next milestone is to keep our budget efficiency. We run the entire company for under $1 million. That's G&A, salaries, everything. And we're in a very strong position. So we intend to keep that budget efficiency and look at returning value to shareholders. Also in our near-term goals is to attract new long-term shareholders, and that's part of the effort here. We see West Vault as a very safe long-term gold investment. We have gold in the ground, which trades at a deep discount to its net present value, as we've discussed, and we're highly leveraged to the gold price. Our annual holding costs are less than the ETF in gold, so that's another way to look at us, that we're extremely efficient in how your gold investment is held. And we're very aligned with our major shareholders, so you know that this company is going to be conservatively and carefully managed as a holding in gold. When are we going to build the asset? Now that we have the permits. We believe we should build it when it's extremely compelling, and our shareholders have a firm belief that gold will establish a new secular high at over $2,200, and at that point we would consider building it. Interestingly, the project build period in the study is 12 months. We even have a 9-month build scenario, which we've done the detailed planning on. So we can pull the trigger on this very quickly and get returns to shareholders. And the key is in this company is to return value to shareholders, either through building it or through M&A. And conserving that value per share is something we're very focused on. So this is quite different, I think, than many of the exploration companies that some investors might look at. And we're dedicated to that approach and philosophy. So with that, I'll say thank you, and we've got plenty of time for questions.
Excellent. Let's jump in. Again, how many ounces of gold would be recovered within the permit limits of first pit? And is second pit is a pushback of pit 1 or a separate pit?
Good question. Thank you. So that's on this chart here. So at Three Hills, it's 175,000 ounces in that pit. It's located separately and permitted separately. Recoverable is 142,000 ounces from Three Hills. And then we move subsequently into the Hasbrouck mine, which is 588,000 ounces in proven and probable reserves, and 435 recoverable. The Hill of Gold, as we mentioned earlier, is about 30,000 ounces in resource. It's not here or in the economics, but it would be planned to be mined at the end of the Three Hills life.
Excellent. What is the distance between Three Hills and Hasbrouck mine? Will there be only one heap leach area?
Good. Another good technical question. So yeah, in our other presentations, we actually have plans of this. So both of the pits have their own heap leach area, and they have their own waste rock area as well, permitted. So the concept initially in the design when we bought the project was to put it all on one pad, but that requires trucking, which is expensive, and we were able to break the two permit areas and permit each heap leach separately, which saves cost. So that was part of the design changes we made when we went back to first principles on the project when we bought it. Good question.
Okay, thank you. Stu?
Yeah, thanks for the presentation, guys. You know, from your point of view, what would be the most challenging part of these environmental assessments for these kind of mining projects?
Well, it's really just time and effort. One area that's particularly pedantic is the archaeological aspect. So because this is a historic mining area, actually, every boot, every piece of timber, every piece of historic I wouldn't call them artifacts, it goes beyond that, junk, frankly, has to be charted, mapped. It has its own report, it has its own location map, and all of those have to be filed. So it's very pedantic. I wouldn't say it's particularly high value work, but it has to be done. So that was particularly cumbersome in the environmental assessment. From a process and net impact point of view, because these projects are quite compact, we're able to keep the project impact under 640 acres, which means it comes under under the shorter process, the environmental assessment, and that's the process that we went through. Having said that, that short form process now is over 100,000 pages of documents in 3 years. So it's certainly rigorous, although it's under the EA, and the finding from that work is no significant impact. So that's what's been declared on both parts of the project.
Right, that's good. And then with that reduction in acreage, was there any, impact to the mineable ounces of gold?
No, it was really a matter of careful planning of where you put things. And so the pits are much smaller than that. And one of the issues is around things like water pipelines and power lines and so on actually come into your total net project impact. So how you manage that particular surface area impact is important in the project design.
Yeah, gotcha. Okay, thanks for that. Alrighty.
Yeah. So that's one question that commonly comes up since it's in the desert in Nevada is about water. So we do have water rights as well for the water that we need. Interestingly, there's been some silver exploration around our area. One of the things just on the north edge of our property is the Rex shaft, which was taken down for the older silver veins in the region. And there was some production from that. That's not something we're pursuing in terms of exploration, but the Rex shaft was actually closed because they had 1,000 gallons a minute of water inflow. So we definitely know at that location there is that much water. It was proved for years, and we have water rights that we can go and get that water, and we transfer that water down to the larger Hasbrouck pit, which is also in our permits that we've obtained.
What are the future studies that can make the operation outlined in the PA more profitable? What are the potential optimization gaps?
So it's a PFS beyond a PA, but that's fine. The question is still interesting. So I think the big thing is, on the metallurgy, we've studied that to death, frankly. We've had 12 rounds of metallurgical test work and included a bulk sample at Three Hills. So I think that's reasonably well optimized. The area where I see potential is at actually Hill of Gold, at adding that into the production profile. And there is an intercept of about 100 feet of a gram on the north edge of the Hill of Gold deposit that's still open. So that's an area where pit pushback at Hill of Gold could add ounces, and that's nowhere in our current economics. And then, as I mentioned in the presentation, and I saw this actually at Barrick's Bullfrog mine, which is a couple of 100 miles to the south of us in the same rocks, that being able to either underground mine with an adit or slot pit the high grade root of this system, I see that as a significant potential at the end of the Hasbrouck life. So those are the main upsides. In terms of exploration potential on the property, it's a large property position. There is potential. There's also been a fair amount of work spent, a fair amount of money spent on exploration. So I would like to be able to say that there's an easy target for a fourth and a fifth pit, but I can't point to that today. And I think our strategy, again, is quite important, that we're being managed as a careful, conservative custodian of reserves in gold to return value to shareholders, and rather than a high risk exploration story. So I think that difference in philosophy sets us apart for an investor.
Thank you. What scenarios did you study on PEA? Are you planning to buy or lease the equipment, or are you planning to use contractor or self-operation?
Yeah, that's another good question. So yeah, we priced things as a contractor operation. So in terms of equipment, we were purchasing that, but we were contractor operated. So this operation is very straightforward. I mean, essentially, you're just pointing at a hill and say, put that hill over there on that plastic liner. So from an operational mining perspective, we contract priced it with purchased equipment. So I think, in terms of the crushing circuit at Hasbrouck and so on, that's purchased. But in terms of the mining profile, that's contractor and contractor priced, and that's appropriately priced in the operating costs.
You're not. Right.
Thank you.
Can you give some? Sorry, go ahead, Artie.
You mentioned that you are using something like 45 degrees for the slope angle, and the studies you have are enough to start the construction. But what if you make some studies today and come out with a higher slope angle that doesn't add any other resource?
We looked at that, or lower the strip ratio. So again, that's a good question. From a technical point of view, because these reserves stick up out of the ground, the pit angle is relatively insensitive, if you will, because a good part of your stripping normally is in air, actually. So it's quite interesting that you can set that pit angle quite conservatively, and it doesn't have a drastic impact on your strip ratio. So that's the reason we did that, is to save the extra geotechnical work, is just set it at 45. The more interesting thing is what happens to the root of the deposit, and because of its position, we don't have a lot of drill intercepts to be able to push that pit deeper, but certainly the lower benches is something that you would get involved in, what the maximum angle of that slot, if you will, in the bottom of the pit can be, and how much that high grade core of the root of this system. I mean, effectively, this thing is kind of like an epithermal flower that comes up from a root, and it fans out as it gets near what the paleo surface was. And so that's these thousands of fractures are what actually makes the deposit. So it's very, very disseminated in the upper section, and it comes down narrower as you get to the root. So I'm personally very interested in what the shape of that root is and what the grade profile is, but that's not something we can just simply tighten the pit angle and grab, because we need the drill intercepts to be able to do it anyway. So there is good upside potential there. I think it could be quite a lot of ounces there, but it's very difficult and expensive to assess from here. And again, if we were to go after that, we could have quite an exciting profile, but we'd also dilute the shares by the shares we'd have to issue at a ridiculous multiple to NAV. So that's part of the reason of the conservative balance that we've taken.
Thank you for the answer, Campbell.
Can you give us some insight, Mike, into the schedule for engineering, procurement, and construction delivery up to operations?
Yeah, so it's a 12-month build as set in the feasibility study and one of the feasibility work. And one of the things is we've had the time during the permitting timing to actually look in detail at the Gantt chart around construction. So We have a scenario that we could bring this into production in 9 months. It's a little bit more expensive. You go into 7-day operation and in some cases 24 hours. But there are no critical path long lead items that we couldn't achieve. And one of the things we're looking at is a turnkey solution off detailed engineering for the recovery plant. So the carbon columns and steel tanks and all that sort of stuff, using a standard design from that rather than the custom one that was priced in the feasibility study work. So that could shorten a bit of the lead time and so on and push. But you know, at 9 months, it's still very quick. And we do have the detailed planning there. So once the shareholders and the board make the decision to go, we're in a position where we could execute. We can literally push the button the following morning.
I mean, have you started now? Do you every day call people or?
Well, we're busy with updated quotes on a you know, weekly and monthly basis. So we're in contact with contractors and builders, certainly around the recovery plant. That's something we're actually working on the further tightening of that time schedule right now. But it's not, we have not made a construction decision, and our shareholders have been quite clear that they don't want to do that until they see it as extremely compelling. And you know, as surprising as it may seem, you know, 100% IRR is not motivating them because they see the opportunity to get a better gold price with a bit of time here.
Does the CapEx include the development of both mines or just the one?
That's a great question. So the CapEx that we quote there, $47 million, is the peak funding. So it's the bottom of the cash flow curve. It's the amount of money injection you need. So $47 million. The capital on Hasbrouck is quite a bit larger. It's in the order of $80 million. And the reason for that is because you've got 3-stage crushing, and you need to set up for quite a bit larger and longer term operation there. So that crushing circuit is something that's in the sustaining capital to the operation, not in the initial capital. However, at current gold prices, or even down to $1,200, the money you make out of Three Hills more than pays for the capital you put into Hasbrouck. So the cash flow curve is kind of a bit of a camel's hump, where you come down to 47 as the lowest point. That cash then goes and builds Hasbrouck, and off you go.
Stu?
Yeah, and obviously congrats on the recent, you know, cleanup in the cap structure and the financing. And so just wanted to get some, you know, comments on the motivation for that, you know, whether that was, you know, wanting to clean up the cap structure, or, you know, a need for both parties, or auditing yourselves, or from a funding angle and having it easier to finance with debt, you know, a cleaner ownership structure of the asset.
Yeah, so our understanding is that Waterton was winding up that particular fund. So it's an opportunity that came along. We were obviously the very logical buyer. You know, they've been a great partner. They've paid their cash calls on time. They've been very straightforward to deal with, and the opportunity arose that they were winding up that fund, and we were the most logical buyer. And they did take $1 million worth of stock. So they clearly see the upside and the share side of it with it consolidated. So when you model all of that, you know, they do have a good interest, and we paid them. And you know, from our point of view, it was super accretive. I mean, we bought their interest for $10 million in cash and $1 million worth of stock. That interest, net present value, to $73 million. So it was very accretive, and it was good trade for both sides, given that we were the logical buyer. They do have a trailing interest as well. I didn't mention in the presentation, but if we sell the company for more than $50 million, they do have a trailer. They called it their anti-schmuck clause. They didn't want us to all of a sudden flip the 100% interest, and they would be embarrassed. So, but that goes out over 6, 12, and 18 months. And obviously we control the timing of whatever transaction we might enter into. But right now, you know, we're really focused on our next milestone, which is getting the royalty value crystallized. And then we've got some work to do to make sure the company's properly valued. And now that the permitting and all the technical work is behind us, we can really focus on that part of the profile.
Yeah, no, it was definitely a good transaction. And with the financing that occurred with it, roughly what percentage of the money came from existing shareholders, and what came from, you know, fresh investors or new eyes to the story?
It was about 65-35 off the top of my head. So, you know, Ruffer and Sun Valley were there pro rata. And we had some other institutional shareholders come in pro rata as well. So Gold 2000, you know, is at their percentage. I think that we did attract some new interesting shareholders, including Eric Sprott, and a couple of new institutions as well, and a little bit of a broader retail following, which frankly is something we do need to work on. As I said, liquidity is a challenge because of the 72% owned, and you know, that's just work. We just have to get the word out about how this is a secure gold investment that you can hold and attract some new like-minded long-term shareholders, and that will tighten the capital situation on the trading of shares.
Yeah, no, it's definitely been, you know, a nice move up in the last little while post this deal. That's good.
Yeah, it's still trading at 0.2 times NAV though, frustratingly. Although our performance has been, you know, in excess of the GDXJ. You know, before we get too congratulatory to ourselves, we have to look at the performance against the NAV, and you know, that's not very good. So we definitely have some work to do.
Yeah, noted. Thanks for that, Artie.
Since 2016, do you think is there any significant changes in OPEX numbers?
Another great question. So we did look at that. The short answer is no. There's not been a significant inflation. The biggest part of OPEX is just moving rock, frankly. And you know, diesel prices and other prices of moving material have not changed that much. So we did do an evaluation of that a few months ago, and we didn't see any need to update our feasibility study work. Good question.
Thank you. And again, what does your ore look like, and can you comment on its cyanide consumption?
Gee, I had that question recently, and I should have gone and got the answer. On cyanide consumption, all I can say is it's normal. The number of pounds of cyanide per ton of ore, I don't remember that number off the top of my head. I wish I did. If we were actually operating, I'd know it by week. But it's normal. There's nothing unusual in cyanide consumption. The ore is all oxidized, so there's no sulfide whatsoever, and we're nowhere near the sulfide interface. In my looking at the core, I saw one piece of sulfide about the size of a match head down 1,000 feet. I was just happy to see it, but I haven't seen any otherwise. So it's all extremely oxidized, and the Three Hills deposit is very friable. So it's a tufaceous rock that's quite permeable, but it also breaks along thousands of fracture surfaces, and the gold is actually sitting on those fracture surfaces. So the reason that we get run of mine as our production profile, and no change if you crush it. If you crush Three Hills ore, doesn't matter. The gold is sitting on the fracture surfaces. As soon as you drill and blast it or move it, it basically falls apart on those fracture surfaces. So we get 81.5% recovery out of Three Hills straight. In terms of Hasbrouck, it's different. It's harder, and if you crush it more, you get more gold out. In fact, there were studies done where they actually milled the the Hasbrouck gold, and they got up to 90% recovery. So obviously with the grade where it is, you don't want to mill it, but the more you crush it, the more gold you get out. We know that profile exactly, and we've optimized the crushing to hit that number. So yeah, that's the two profiles of the two different ore types.
Thank you, Campbell.
What is your projected recovery on heap leach? Have you done any tests? And what are the tests from the, who studied the tests?
Sure. So yeah, we've done extensive test work, 12 rounds of metallurgy, including a bulk sample at Three Hills on the run of mine. So on this chart, it shows the recovery per pit. So it's 81.5% at Three Hills, and it's 74% at Hasbrouck, for an average overall of 75.7%. The tests were done by McClellan Labs and Kappas Cassidy independently. Both of those are very well qualified metallurgical firms that do this kind of test work all the time. And as I say, it's been done there have been 12 different rounds of optimizing and studying the recovery on these rocks. So we definitely know what the recovery is. And the bulk sample was quite satisfying. It was a 20-ton bulk sample from Three Hills run of mine.
Okay, thanks. And I was going to ask, could you just rephrasing someone's question, but it comes down to, could you sort of highlight just how unique Westfault mining is as mining, juniors go? I mean, it really is quite unique, but there are a lot of Nevada plays there, but certainly not many are fully permitted. So if you could just elaborate on that.
Sure. Yeah. I mean, the key here is that, as you said, we're fully permitted, ready to go. So that, that's 3 years worth of work and many millions of dollars in patient, frankly, kind of non-exciting kind of work. I mean, it's not the kind of thing that drives investors crazy, but it does add a lot of value. You can put the IRR and the NPV here on a chart that the timeline, you pull the trigger. So I think that there's a significant difference in this asset rather than an early stage exploration asset. And of course, exploration has its risks in itself, but it also has permitting risk. You may be able to find a great deposit, but not permitted because of a special characteristic. So all of that risk is behind you. And then the next thing is really, how is the company going to be managed? So running this company at under $1 million a year, providing direct drive to gold with very low cost is significant. And the opportunity to be able to move with the gold price with a secure US-based block of gold is very different than an exploration profile where you're betting on the next drill hole. And from a value perspective, you can see the clear value demonstrated by the engineering, and that this is safe and defended, and that there's 72% backing by major gold institutions who have done their work, identified the value, put their money there, and you can invest alongside them with a lot of security that this company is well backed. And that's the difference. This is a different style of investment. This is a holding in gold in the United States that you don't have to worry about.
Excellent. Getting technical again, from the 2016 PFS, Three Hills Mine cyanide consumption 0.45 pounds per ton, Hasbrouck Mine 0.7 pounds per ton. Is that correct?
Sounds right. If it's in the study, yeah, it's low to normal.
Okay. Should we expect a reserve update in the near future, or the reserve is pretty much defined for now?
Reserve's pretty much defined for now. Another good question.
Excellent. Stu?
Yeah, and do you have any plans for any drilling or further exploration, or is that going to wait until construction's commenced?
Definitely going to wait until we get a proper valuation. So dilution for exploration drilling is not in our strategy. So different in that point of view. And as I said before, it's a plus and a minus, right? It gives you the upside of growth potential, but it also dilutes your value. And this has an opportunity to return significant value to shareholders. I mean, it's $5 US NAV discounted per share. So, returning that value to shareholders is very significant. And on an undiscounted basis, of course, it's higher than that. So this is an opportunity to own gold and get that return to you and not have it.
Yeah. But I mean, you're saying companies get rewarded for the dilution for drilling after the fact. So I guess, yeah. And then I know traveling has been hard this year since March, but many of your shareholders listed on your presentation conducted site visits.
Sun Valley has. I can't remember if Rufford has. I think they have. Eric Sprott hasn't, to my knowledge. Gold 2000, I believe, has. So, 3 out of the 4 on that page, I'm pretty sure have.
Yeah, that's good. Right. Artie?
Yeah. So in terms of work and ability to travel and so on, interestingly, in my other business, I just came back from Africa, so I'm in the Canadian 2-week quarantine currently. But I've been in Switzerland, Sweden, Germany, England, and Africa in the last 3 weeks. So I've actually had COVID, so I've declared myself a superhuman and I can go wherever I want. So if I could get across the US border, I would. But actually, we don't see that restriction as an impediment to production either. We could do that all from here.
Yeah.
All right. I'm going to move to close, and I want to thank everyone for tuning in. People really sent some great questions in, and here at Amvest, we enjoyed digging in a little deeper, and congrats on all the permitting news. So, we'll be queuing you for feedback. Please share it. And Mike, a closing remark. Well, should we go to our put an order in 5 minutes?
Yeah.
Tell me some
well,
stuff.
we hope to add some significant shareholders. I don't think it'll take a lot actually to make a difference on the shares because of the structure. So it is something that we are looking for people to work with and to work closely with. And if you have questions about our direction or our timing or what's happening, make sure to send them in to us. We'll be responsive as we can, and we are going to do a lot more of this sort of work. So expect to see an improvement in the breadth of shareholder interest in this company. It's something we haven't been focused on for quite a while, and we are going to be doing more of this work, which should improve liquidity and bring us some aligned long-term shareholders.
And what's the best way to reach you and or the company?
Just through the info account at Westvault. I get a copy of those emails directly. So if you go to info@westvaultmining.com, I will see those directly.
Excellent. Thank you. And thanks everyone for tuning in, and let's all follow this closely. And it's a great environment, especially today. So
yeah, thanks, Campbell. Thanks for the team. Cheers.
Thank you.
Bye.
Thank you.